Hey y'all, no nonsense financial coach here. Probably gonna be the last part of my talk on credit cards for now. Because I use them, but I don't necessarily recommend everybody use them. So I don't want to make my whole channel about credit cards. Just kind of wanted to get it out of the way. Um, Sorry, I'm filthy. I've been weed eating all morning and taking a break, enjoying some coffee. Enjoying the view. Mountains, everything's green. Sound effects today. How's that for production quality? We have all the chickens right there. There's some over there, up on the hill. Some of them are in their run. Not a whole lot, but yeah, they're loud, and they like to make sure you know they're here. Okay, last look at the chickens. We have Barred Rocks and Buff Orpingtons. Pro tip: don't get chickens to save money on eggs because it doesn't work. But we like having them. All right, so credit cards. Wanted to talk about credit scores. Sorry, guys, I'm trying to get the lighting right. There's kind of 5 things that make up credit scores. 5. 1, 2, 3, 4, 5. Did that for all you OCD people. First one's payment history, and it makes up 35%. It's the biggest one. So the short answer is pay your credit cards on time, pay your loans on time, pay your mortgage on time. Would you stop? You're loud. Rude. Yeah, pay them on time. Enroll in auto payments for everything. For your mortgage, for your installment loans, for your credit cards. Just put them all in auto payment. And again, guys, I'll go back to what I said about credit cards was the only way that I think it's acceptable to use them is if you actually have the cash reserves to cover the expenditures you have on the card. So if you spend $4,000 a month on a credit card, maybe I went overboard with the sound effects. Have $4,000 cash in your account at all times to be able to cover all that. So auto payments, pay them a little bit early. Stay tuned to the end. I'm going to give you a little bit of tip on payments and balances to kind of bump your credit score up. But we'll talk about that. Number 2 is the amount you owe. And sometimes this is referred to as credit utilization. So if you have let's say a $5,000 limit and you have a $2,500 balance on your credit card, that's a 50% utilization. It's 50% or half of your credit utilization. What most lending agencies, credit bureaus, what they like to see or what helps your score is keeping it under 30%. So try to do that as best as you can. So if you have a $3,000 limit, or let's do a $10,000 limit because that math's easier for my brain. I'm like poo. Complicated things bother me. If you have a $10,000 limit, 30% would be $3,000. If you have a $1,000 limit, 30% would be $300. Yeah, did I say that right? $3,000 and $300. And that it's individual cards, but then also as a whole. So if you have one card that's maxed out, that's got a $1,000 limit, and another card that's not maxed out, that's got a $1,000 limit, or that has no balance on it, your utilization is going to be, what would that be? 25%, because you've got a $1,000 limit, that's $2,000 limit, and you've got $500. So that's 25% utilization. So it's each card individually, but then on average, across all your lines of credit as well. So 1's payment history, 2's amount owed. Number 3 is your credit history length, and I think it's 15% on this. It makes up 15% of your credit score. So the longer you've had credit, the longer you've had credit cards, the longer you've had loans, the more that helps, because they see a track record is essentially what it is. How long you've had credit, and then they kind of take into effect the oldest, the newest, and then sort of like what an average is. So you might have one that's 15 years old. You might have one that's a month old. So your, average would be 7.5. And I don't know all the details of how that plays into it, but the length of credit history that you have makes up 15%. I think it's 15%, right? So you got 35, 30, 65, 15, yeah, 80, and then the last 2 are 10% each. Number 4 is your credit mix, which is basically just the different types of credit you have. Now there's sort of categories here. There's installment loans, which is like a car payment. It's just a set dollar amount that you borrowed, a set interest rate in most cases, and then a set monthly payment that you have to pay back. That's an installment loan. You're making installment payments to pay off the entire borrowed amount plus the interest. And then there's revolving, which is a credit card. You could also get like HELOCs, home equity line of credit. But it's basically the things that you can use money from and then pay them back or carry balances, which you shouldn't do. Don't carry balances ever. And then so credit mix makes up 10%, and then new credit or inquiries make up 10%. And usually it's usually a bad thing. If you have too many inquiries in a short period of time, or they see you constantly applying for credit and being denied, that's going to affect your credit score up to 10% negatively. Now, there's smart ways to do this. If you're the kind of person that you absolutely want to maximize credit card rewards, and you say, okay, I've got this one card that I use for gas, and I've got this one card that I use for travel, and I've got this one card that I use for restaurants, and then I have 20 different cards that give me the most cash back at each of my 20 favorite places that I go. You can play that game, and there's a smart way to do it. What you don't want to do is go and apply for all of them all at once. Because what this, as I understand it, what this kind of looks like to the credit bureaus and the banks and stuff is that you're a flight risk. You could very easily in one day go to 20 different places and apply for 20 different credit cards and possibly get them all. And if each one of them has a $2,000, a $5,000, a $10,000 balance, you could end up with kind of in one day, $150,000 worth of balances. And there's a certain amount of risk that the bank's taking in letting that kind of stuff happen. So they're going to look at, all these factors, but then just your new credit inquiries and how often you're asking for more credit. And that makes up 10%. So you've got 35% for payment history, 30% for the amount you owe or credit utilization, 15% for your credit history length, 10% for the mix of credit you have, and then 10% for how many new credit inquiries you have kind of in, whatever, the last 6 months. I don't know all the details of the metrics that they use. So that's basically what makes up your credit score. So 35, 30, 15, that's 80, and then 10 and 10, that's 100%. I didn't miss anything. Couple of tips that I like to tell people. One, we talked about the rewards. Use a card that the rewards make sense for you. Always pay off your balances. Sort of one in the same tip is the credit utilization. Definitely keep it below 30%, okay? Now, if you're the kind of person, like we try to put everything we can on the cashback rewards cards because we try to maximize that because all that money goes into our retirement investment accounts. If you're doing that, you could very easily, let's say you pay all your bills the first week of the month, you could very easily get your utilization on those cards up to 60, 70, 80%, overnight. What I like to do is I'll just go in, sometimes I'll do it more than once a week, but once a week, go in and pay the balance down at least below 30%. Again, always make sure you have the cash on hand to pay the card off. We're not using cards to finance stuff. We're not doing microfinancing with them. Make sure you have the money to pay it off. But beyond that, make regular payments to pay your balances down. Because the reason why is your statement date might close on the 20th of each month. Well, that doesn't mean that the credit bureaus and the banks are recording and reporting your credit metrics on the day your statement closes or on the day that your payments due. They're just getting snapshots at any given time during the month. So if you want to try to boost your score, always keep your credit utilization down below 30%. Maybe what you do is say, I'm not going to make any payments over, 10% or under 10% until it gets to over 30%. Then I'll pay it back down from 30% to 10%. So if you have a $10,000 credit limit, you say, I'm not going to pay anything down throughout the month. If it's below $1,000, once it gets to $3,000, I'm going to pay $2,000 to get it back down to $1,000, and then I'm going to let it, use it and whatever until it gets back up to $3,000 and pay it down. That will always keep your credit utilization under 30%. Now, an extra tip, if you want to do this kind of on a micro level, there's some statistics and reports that say that 1 to 3% credit utilization is the best place to stay for keeping your credit score high. Now that gets super tedious. $10,000 limit, 1% is $100, 3% is $300. So trying to maintain a balance on your credit card between $100 and $300 is probably going to mean every day you're going in there and making payments. And if you want to do that, if it's convenient for you, if I have a way to set it up, I can do that. Takes me 30 seconds to go in there and do that, because I know the cash is in our checking account, and I can just do it each day, every couple of days, and it works out pretty good. So hope that was helpful. We're at about 10 minutes. I don't want to keep rambling. Like, comment, subscribe, share. Tell me, Andrew, you need to take a shower before you do a video like this, because it's super unprofessional to be covered in grass and weeds and stuff, but is what it is. Thank you guys for your support. Thank you for listening to my chickens in the background. We love them, even though they're a pain sometimes. Thanks, guys. You can do it. See you tomorrow.